Hello, America. This is video one in a series about the banking system of the United States. Video one, how the Federal Reserve System underpays the United States Treasury. What is the Fed? The term Fed refers to the Federal Reserve System, which was created in 1913 to control the monetary system of the United States. The Fed is a private business. The Fed is a private business enterprise that is comprised of 12 regional, independent, privately owned, run-for-profit banking corporations and a controlling board of governors. The board receives 90% of its funding from the 12 member banks and 10% of its funding from its own operations. The board receives no funding from the federal government. The nation's basic money supply. Economists use the term M1 to describe the basic money supply in the Fed system. M1 money is money that is considered to be on demand or immediately accessible. M1 consists of all the physical cash and coin in circulation, all the electronic digits in all the checking accounts, and a tiny number of traveler's checks issued by non-banks. All the electronic digits in all the savings and retirement accounts are included in the M2 money supply because those accounts are not considered to be on demand. What is not included in the definition of M1 money? All the physical cash and coin held by banks, the U.S. Treasury, and the Fed itself is not considered M1 money. All the digits in all the bank accounts that exist in the name of banks and the U.S. Treasury are not considered M1 money. They are called reserves. None of the 12 Fed member banks have any bank accounts. Therefore, and by the Fed's own definition, the Fed has no M1 money and maintains no reserves of its own. The reserves which it creates are for the commercial banks. The Fed doesn't pay for expenses. It creates reserves by making journal entries. That's correct. The Fed does not pay for anything in the way a regular person or business does. The Fed acquires all its assets and satisfies all its expenses by simply creating reserves. The Fed creates reserves by posting journal entries into its accounting system. In 2012, Chairman Bernanke described how the Fed, after 2008, acquired $2 trillion worth of U.S. Treasuries by creating reserves with journal entries. The franchise tax owed by the Fed to the United States Treasury. According to the Federal Reserve Act of 1913, page 8, section 7, the Fed must pay a franchise tax to the U.S. Treasury. The amount of the franchise tax is the net earnings that remain after deducting 1. All the operating expenses that have been paid or provided for. 2. A 6% dividend to the stockholders of each Fed bank. And 3. An amount to be paid into a surplus fund. Regarding what is paid for, the Fed cannot pay for anything because it has no money and it has no reserves. It only creates reserves. Regarding provided for, this term refers to the accrual of expenses to be paid for in the future. The Fed underpays its franchise tax liability. In calculating the franchise tax owed to the U.S. Treasury, the Fed has been allowed to deduct operating expenses that it does not pay or provide for. When people make payments, they become financially diminished. That is, they have less money. When the Fed creates reserves, it is not financially diminished. Creating reserves is not the same as making a payment. As a result of this practice, the amount of franchise tax sent to the U.S. Treasury by the Fed is significantly less than the amount that is actually required by law. The Fed does not pay its fair share. Every year, the Fed deducts billions of non-paid and non-provided for operating expenses to reduce its franchise tax liability. This is how the Fed underpays the United States Treasury billions of dollars every year. Watch for future videos. Future videos on this channel will include how banks underpay their corporate income tax liabilities and a specific, doable, effective call to action. Until next time, thank you, America.